webinar. Today's session, we'll discuss more about gold, and on the fundamental question, will gold shine bright in 2019? Some of the economic fundamentals, geopolitical happenings, and market sentiment, of course. Hopefully, from there, we can derive price trajectory, and also our viewers can have some good takeaways for the outlook for gold in the current term. Now, before I begin, I'm tasked to share on our presentation disclaimer. So do note that the content is an express with ample research and analysis done by myself on the subject matter. In a nutshell, please seek advice from my colleagues or me should you have any queries. Okay, I think the link is posted at the end of the slides. You can see it later. Okay, so let's move in. Presentation agenda, the narrative is relatively simple. We will do a sequential approach, 4 mini segments. So the first, we will discuss market recap. So we'll discuss the idea of rising safe haven appeal in 2019. So what rise in gold prices, the fundamentals, and also a technical. And lastly, my favorite, an assessment, our house view on where gold prices are going in the shorter term. So next, we're going to look at B, market overview, where I'll touch on the key market themes that are going to move markets for 2019. A little bit on macroeconomics, and you will see how does this affect asset classes and of course gold in the current term. Lastly, I'll highlight on the fundamentals, geopolitical happenings, and more importantly on the US dollar, as that is a prime driver for. So as we look at the third segment, of course, is a postulation, crystal ball question, if I may, on the viewpoint of pricing direction and levels. Let's dive a little into technical analysis, actual takeaways. So on the fourth portion, I think that this is important. I will share on how investors can trade gold for those new to this product class, and also trading of futures. Any further ado, let's look at the first slide. So, okay, as we can see over here, COMEX Gold has appreciated by 14% since Q4 2018. As we last saw, gold prices actually broke out from range-bound conditions. We saw it testing previous levels about 1175 before a sharp turnaround was seen. So you can see that it has largely traded in between the bullish channel for most of the last 5 months, although severe headwinds have continued to impede a strong growth. Although in the last week we have seen some positive conditions, we are going to give you our view on actually why this is happening. So what are the fundamental reasons behind this bullish breakout, and why has market sentiment shift from drop here of 2018? So 5 key points that I wish to highlight that has denoted the rise of safe haven appeal in 2019. So as we look at global economic indicators in the fourth quarter, signs of weakness and slow prospects have actually surfaced in lieu of market conditions. Now we saw dark clouds, of course, the first being the actually projected for slowing economic momentum, and they've reduced growth forecasts to 3.5% and 6% in 2020. So what has actually transpired is that we saw a massive sell-off in the financial markets. It's like oil was severely. So actually, what are the fundamental reasons? I'll tell you it's primarily market. There's 3 key points, but I'll share with you the first. So the first is that we postulate that the lagged effects of monetary policy tightening will kick in and impact markets. So these bearish pressures, right, as the Fed has raised interest rates for the 9th time to 2.5% since 2016, this is expected to weigh on corporate earnings, financial market liquidity, and credit in the global market. So even if the Fed has a very neutral standpoint, as it states in the minutes, right, tonight it's going to come out, probably they will illustrate on patience. This is likely not going to be supportive to the global economy in whole. And also, the boom which you saw in actually the second quarter was largely due to the fiscal stimulus program, corporate tax cuts. So all these are likely to ease up and wean off in the longer term, as all this, the economic performance is not likely to go up in lieu of monetary policy tightening. So more importantly, a political divide within the U.S. House and the Senate, which is the House is controlled by the Democrats and Senate the Republicans, will likely prevent an increase in fiscal stimulus. So it's hard to give the economy a boost in view of differing opinions. And also, as we look closely, the debt level is expected to rise to 1 trillion for 2018. So all this is likely to impede talks of any fiscal boost. So to say the very least, we are going to see dimmer conditions in the global economy and also better conditions for gold as a safe haven asset. Now, third point I would like to talk about is actually China. So China, which has been undergoing a financial deleveraging policy since 2017, 2016 actually. So all these lagged effects, right? Even with the fiscal stimulus, reverse reserve ratio cuts they're implementing, all this are actually going to negate and weaken market confidence. It has already did so. So with the impact of the trade barriers as well, all this are likely to transpire into a very broad-based weakness. As we look, these two are the world's two largest economies. So in view of this, along with the last key point, the rise of populism in global politics, we have seen Brexit. We have seen a political divide in the US with the Trump administration taking power, an anti-establishment government in Italy, a far-right presidential elect for Brazil. All this is going to raise geopolitical risks and market risks in the current term. So how does this actually impact, right? It's like for trade barriers, for example, we have seen global supply chain disruptions, rising market uncertainties. All these contagion effects have a marked effect on volatility, and we have seen that strongly since 2018. So now with these five factors, it is our view that this is why gold prices have largely benefited in the current term from its reputation as a safe haven asset and a solid store of value during tumultuous periods. Now, besides this, I would like to highlight this. So the dollar is a prime mover of gold. As we study the precious metal, right? We need to know that because the gold is denominated in the USD, and also with the dollar status as an interest-bearing asset, and the precious metal is a non-interest yielding asset. Traditionally, both assets have an inverse relationship. I say amount 60 to 65%. So this chart here actually shows the correlationship between both asset classes. So now, where we have seen sometimes is that in the last 180 days, which is about 6 months, right, there's been a sharp break on certain occasions. That is where you see over here, when traditionally, when the US dollar goes down, you can see over here, gold prices are going up. But over here, we see that both are actually moving in the same direction, where the relationship actually fails to a negative 10%. So this can be construed as very strong support that buyers are coming into the market in lieu of attractive prices for gold, despite the inverse relationship traditionally. So even if we zoom in now to a 30-day rolling correlation, right, you can see that in the last few days, maybe in 14, right, the relationship has broken down several times at about negative 16% over here, you can see. So this is at key levels actually, where we have seen at about 1,300 key psychological level. That is where strong support can be seen. So that is actually why we notice that as with these sharp breakdowns, despite the presence of stronger dollar in the recent term, we have seen rising signals of bullishness for the precious metal. That is why in our current term assessment, we still see positive showings in trading relationship for gold in the first quarter of 2019. So, okay, I think I'm going to give you a short-term outlook for those of us, please, of course, do take note that, this is an expression of belief. Please do your ample due diligence for this, okay? So, 4 key reasons I have highlighted, right? The time frame is for the first quarter. We are still mildly bullish for gold futures. So the first thing is we see flagging economic growth, the weakness in Eurozone, PMI, Chinese economic indicators, monetary policy, tightening the effects and fiscal stimulus. All these are likely going to weigh in on the global economy and actually dim market confidence. The next point is on geopolitical risks. With uncertainty in Brexit, what's going to happen, we'll discuss that a little more later. But in the first quarter, deadline is about 29th March. And also for the US-China trade agreement, nothing structural has been seen for 1st March. We feel that this is likely going to support gold prices, to say the very least. And the third point is on the lagged effects, as I was speaking earlier on. This dovish signals from the US Fed is likely going to bolster gold in the longer term. But the point that has been impeding the sharp gains in gold prices is actually we have seen bullish conditions in the US stock market and also the US dollar. So these competing influences have likely capped gains in longer term. But overall, as I've shown the rolling correlation, we have seen quite a break in the relationship as they near key psychological levels. So, okay, from a technical perspective, where do we see gold prices going? Mildly bullish, a sharp breakout, trading within channels, but I have did a Fibonacci retracement. There are some actually concerns that it has been from a stochastic oscillator point of view, that the illustration is showing for oversold levels. So yes, we do note that a retracement is possible. So actually we spoke about a retracement actually 2 weeks ago happened, but we can see strong support actually keeping gold prices up around key psychological levels. One of these key reasons, of course, global central banks have started to recognize the changes in a 10-year bull market and be starting to buy gold, and this has been largely positive. So from our view, what's likely to transpire in the current term is that we're likely going to revisit previous highs, 1365 to 1375 over here. Should we see a positive continuation and a bullish trend scenario transpiring, we can expect for gold prices to hit 1375. That is where the key will be at. And we still continue to hold and postulate for strong support at key psychological levels. And of course, the last retracement will be maybe the correction. If there's a sharp bearish correction occurring, maybe 1288. But for now, this is not where our view goes. Okay, so maybe just to share for some of our listeners, for those who might want to know, what are some of the key drivers for gold? What are the positive variables? So one, of course, if these 5 factors transpire, this will be extremely bullish for gold. First is US dollar weakness. If it transpires, as I said earlier on, gold is denominated in USD. This is likely to bolster prices. Heightened geopolitical risks, as gold is actually a safe haven asset, a store of value when in uncertain markets. So it has a historical record of value maintenance without depreciation. So also, money managers use it to fight currency depreciation from high inflation rates or even currency devaluation programs. Lastly, we look at thirdly, we look at financial market sell-off. All this uncertainty is also likely to boost consumption for gold and flagging global economy. It continues to weaken. We have seen that. It's our view that it's going to be a synchronized slowdown, a broad-based slowdown throughout the markets. Dovish U.S. economic policies, which a hawkish Fed has actually boosted the dollar, right? But if it goes the other way, this is likely going to be positive for gold. So, in view of this, of course, the other side, vice versa, negative. If it goes the other way around, then it's going to be negative for gold. But for now, what we see is the balance of risk is tilted towards the downside for global economic conditions and more towards the upside for safe haven assets. So without further ado, I'm going to discuss more on the key market themes for 2019. So where do we think actually gold prices is heading, or where the market is heading in 2019, and what are some of the key variables? Okay, so 3 key points that I have actually flagged out. The first, of course, we have continued to postulate for a synchronized global slowdown in economic conditions for 2019. So this is quite evident, as we see now. Actually, central banks, even the European Commission, IMF, have actually all noted that it has been flagging 10 years bull run is likely to slow. And of course, they have been implementing active policies. The second point is we note for, in the last few years, we've noted for rising populism in global politics. This has actually raised geopolitical risks and caused a lot of disruption in the financial markets in lieu of the uncertainties. So also with this growing market risk as such, right, the slowing economy, the effects of interest rate tightening and geopolitical risk, we do foresee for risk-off sentiments to actually overtake the markets at some point, and these will likely bolster safe haven appeal, as seen from the sharp sell-off and the sea of red in financial markets that actually transpired in the 4th quarter of 2018. Okay, the first part we're going to discuss more. We're going to look at the US market. We're going to look at the economic indicators to actually help to decipher where markets are going. So is there a looming recession with the bull market reaching its 10-year? We're going to discuss some key themes. Will central bank raise interest rates or even cut rates in 2019? But let's focus on the US first. So if you look at the economic indicators, we see a sharp ascension in Q2. As I said, this is largely due to the corporate tax reform. We saw enhanced corporate earnings, the fiscal stimulus that actually gave markets some strength. But the effects of this is likely to wear off, as what I said before, from the divide, the growing political divide in the U.S. government, actually the House and the Senate to be exact. So besides this, it's going to be difficult to push forward for power the economy forward in view of the current conditions. So we have already seen a curve in quarter three where it's starting to slow, the impact of trade barriers as well starting to hit in. So this is where actually we did a little forecast on, if you get Bloomberg is actually forecast for maybe in Q4 it's about 2.6. Overall still positive, but we are starting to see the effects start to slow. So in lieu of this, we are still dim on the U.S. economic performance. We do not think that it's going to be a recession to start with in 2019, but we do see dimmer and slowing conditions that might cause the Fed to take another active stance in monetary policy in the other direction. For now, we see most probably it's going to be a pause for until the first half, but I'll share with you more why. So the second economic indicators we look at is consumer confidence, as denoted in orange, and also unemployment rate. So consumer confidence notched a 10-year high in the second quarter, but it has since saw choppy conditions. We see actually a sharp drop in the last three releases. So this is in line as well with lowered corporate earnings, tighter credit. So all this is likely going to give a lot of strain to the economy. Automobile house sales, which are strong revolvers on credit, right? These are likely to show strains first, and they have already transpired. So unemployment rate, which is although it's an all-time low, is a lagging indicator. It doesn't really show strain when the recession hits and when companies actually start laying off workers. So what we feel is that, in lieu of these recent term developments, the Fed is still likely going to pause interest rate release because consumer confidence and GDP hasn't been showing for very positive figures. And if we move on and we look at the retail sales and the US PCE inflation, which is denoted in blue and orange, we see that for the first part, retail sales has actually weakened, shown for actually very choppy conditions. But as in line with the consumer confidence, right? There's a lot of weakness. Retail sales in advanced economies have actually dropped by 0.9% in December. So in the year-on-year terms, their growth rate has actually slowed by 1.7. So actually, most of this data has been is lagging a bit due to the government shutdown. But we believe that the slump in motor vehicle sales, all this has actually shown evidence that the consumers have started to tighten their belts. So even where we look at inflation, right, we saw peak inflation at 2, somewhere within the second quarter. This also it also actually gels with the GDP performance, but we can see after which there's a drop. So it seems to suggest, from our point of view, that this is actually the peak inflation rate, with consumer confidence and retail sales looking to weaken. This is like the weakness is likely to stay, and the weakness in inflation rate is likely to keep the Fed from raising rates as well, especially since there's a sharp fall in oil prices and the Trump administration determination to keep oil prices low. So we feel that inflation levels are likely to be very subdued. So with inflation levels and consumer confidence in GDP not showing for prime conditions, although unemployment rate is still solid, we feel that is most likely interest rates is not going to rise, at least for this time. We do not think that they're going to cut interest rates for so soon, but for the first half at least, I'm saying that we haven't seen any evidence that the market is pricing in towards an interest rate hike for the US. Okay, next we're going to explore a bit on the PMI. So as we look at the PMI for the US, for example, which is denominated in blue, okay, we have seen the uptick, still largely, I think, positive. But the rest of the world, now what is important to note is the rest of the world are showing for signs of weakening. If you look at the EU, there's in yellow, sharp drop. In Japan, green, also we're seeing a drop, and red choppy, but still weakening in the UK. So now all these key developed economies has already suggested that a synchronized slowdown is on the way. So PMIs is also is a leading indicator. So this is one of the economic indicators that you wish to look at to actually have a broad-based assessment of the government. So with both global economic composite PMI falling to a 2-year low, I think it's pointing that the world's GDP is going to slow, to a slower pace in the last 3 years. So as we look at all this economic activity, looks likely to weaken again despite rebounding in Japan, the one in green. They start rebounding in the fourth quarter. So all of this actually is not likely to keep up strength as trade barriers, monetary policy tightening, and the weakness in the fiscal stimulus actually wears out. All this, when it kicks in, the economic expansionary activities don't look likely to continue strengthening in the current term. So what else do we actually use to decipher our view that supports rising safe haven appeal? This is the US S&P, NASDAQ, and also the Russell. So these three, as we can see, right, we have seen marked volatility from actually 2018. 3 key points. So this is very different from the bull run as the market is entering traditionally the last phase of this economic expansionary phase. We traditionally will see marked volatility. This is how actually the charts look. So it has been 10 years since the Fed has already cut interest rate to zeros. So with that being said, with QE being done, it helps to actually, with interest rate being low, the Fed prints money, they purchase assets within the market. So reverse QE, it has the situation where it actually brings asset prices low. So with this being true, we can see that actually the effects of reverse QE has started to show, and it's going to show more aggressively, in our view, in 2019. Despite, of course, we see some positive inclinations after the Fed announced for a pause in interest rates. So with all these indicators, right, it has actually shown for much weakness and softer growth prospects actually in 2019. So the key question, so will the US economy slow in 2019? So 3 key points. The first, I would like to stress, unlikely to raise hike rates in the first half of 2019. Key reasons because of global growth worries and weakness. So I will sum it up by saying US monetary policy tightening is likely to pause. They're going to pause this in lieu of the recent economic developments, weakness, and of course muted inflation results. Now it's about 1.7. So United States fiscal policy, I don't think they're going to add additional fiscal stimulus programs, and the positive effects from 2018 is likely to wear off. The third point, with economic activity, is going to slow from higher interest rates and the weaning off of the fiscal stimulus. So we are at the 10-year mark. I think in March we entered the 10-year mark for the 10-year bull market. So increasingly with all this, we're going to see more weaknesses. Of course, it really depends if the Fed actually starts to cut rates, and then it's a whole new ball game. But the thing is, we do see also rising debt levels weighing into market confidence. Okay, so the next slide. So let's maybe pull back a bit and look at the rest of the world. So what do we see? The rest of the world, as we look at GDP, the red denotes China. We have seen very flat in lieu of the deleveraging policies that they've enacted. And we have seen weakness actually from 6.7% projected. They have adjusted it to about 6.4%. And even in green, Japanese GDP is also weakening in the past 2 years. And in yellow, Eurozone, though showing for slightly better conditions, are likely to weaken along with the rest of the world. Orange is UK GDP, though relatively flat, has also started to dip down a bit. So we believe that the world is likely to issue for slowest growth since the 10-year bull cycle. So there might be talks on policy loosening on the agenda, but I don't think that will happen in the first half of 2019 in lieu of debt considerations. Now, Eurozone has missed out on the tightening cycle. So inflation levels is also subpar with slowing growth rate. So from there, we see weakness is likely to transpire as well. Then also the European Commission has also cut forecasts in lieu of the monetary policies tightening and also trade war, as long as we saw earlier on the weakness in PMI. So with that, of course, we continue to assess all these core economic indicators as actually promulgated and actually supported our view on the broad-based economic slowdown in 2019. So if you look at China, for example, the second world's largest economy, we have also seen, for example, in this, the PMI, denoted in light blue, and also China's export level. Now let's look a bit at PMI. With PMI, we see sharp weakness, a sharp drop. Okay, in this, and then I think this is natural with the U.S.-China trade tensions. We see global supply chains disruptions, people moving out of looking for new venues, and also we've seen that previously they had a deleveraging policy, which actually started to tighten credit. So this is likely, to transpire. Although they have been implementing reserve ratio requirements cuts for the banks and also fiscal stimulus, the overall effect has been quite negative. Even though China's export levels have been quite supportive and quite positive in the current term, we think that this is in lieu of the weaker renminbi that has transpired in order to cushion the fall from U.S.-China trade tensions, rising trade barriers. But overall, the whole view is still quite soft in the longer term. Even as we move on, we look at the Caixin PMI and also if we look at the China retail sales and the fixed asset investment, both are showing for a sharp dip. So I think from China, right, despite the fiscal stimulus and the economic policies, right, the idea for them is to maintain a growth rate. So part of the policy that has been used to deleverage since post GFC global financial crisis 07-08 was that they carried out supply side reforms, quality over quantity, made in China 2025 policy, and even the One Belt One Road in the longer term. This might actually help to drive growth in the emerging markets, but overall, softer economic conditions have been seen in lieu of the tighter credit in the markets, trade wars, and the effects of deleveraging slowly kicking in. So we feel that this is something important. Although we feel that there might be some support at some point, maybe around 6.2% for GDP or 6.3. They have quite a huge debt level as well. China's debt to GDP ratio is about 280, I think. So with all this, we feel that this is likely to the economic stimulus will prevent a sharp descent, give some support, but unlikely to initiate a sharp turnaround for economic results in 2019. So the synchronized slowdown still looks likely to happen. So again, 3 key points just to sum up my view on a global slowdown in 2019. First, of course, flagging global economic growth in 2019. Bull market enters its 10th year, start to flag. This is not saying that it's going to end next year, but we do see softer conditions. It is really dependent on what's going to happen, what is the central bankers going to do to actually negate this, right? Eurozone economy, we still feel the developed markets are likely to slow down, and geopolitical is likely to impact market confidence. With Brexit, a lot of uncertainty. We feel that what's going to happen for Brexit is that there will be a extension in deadline, but the possibilities of a hard Brexit, right, will actually also continue to impact market conditions. So of course, bulging debt levels from Italy, from the anti-establishment government and the issues, and subdued core inflation will continue to impact economic growth. So as China, just to reinforce my view, the negative effects of previously implemented financial deleveraging policies will weigh in along with the trade barriers. The effects of fiscal stimulus will also prevent a sharp decline in economic growth. So we still continue to hold a very dim view on a sharp turnaround. Okay, so next we're going to cover, after the dry subjects on economic fundamentals, we're going to touch more on market sentiment, geopolitical risks, on the effects of populism on global markets. So how has this actually changed in the last 3 to 5 years? So first, we see that this effect is likely to cause enhanced market volatility in 2019 at much pain points. So of course, the first we've seen the America First policy. So once after the Trump administration took power, we've seen trade protectionist agendas, right? They have actually issued tariffs on EU, China, Japan, South Korea, core allies, and also it has renegotiated NAFTA, pulled out with the TPP, and now we see a divided political house, and the implications has been very apparent since December. The government shut down due to the Mexican war. It's very difficult to pass policies in a divided House and Senate. So especially in 2020, where we see the election coming, we postulate for more market volatility as the Trump administration will need to actually they call voters and swing voters to show that he's following his mandate, which is America first foreign policy. So this is going to largely likely to going to cause enact geopolitical risks, and wild swings in the market in lieu of what's going to happen. Secondly, if we look at the US-China trade dispute, already 3 rounds of trade tariffs have been passed on Chinese products, 250 billion from US to China, and for China it's retaliated with 110. So the 90-day trade deadline is due on 1st March. As we have seen now, a lot of positive notes. We think what's good likely with President Trump in the field is what's likely going to transpire is a face-saving agreement. But of course, broader political issues will continue to plague the relationships, as in lieu of all the difficult technological and also market access issue. Now, we're going to discuss slightly later, although we feel there's face-saving agreement, but the Trump administration has known to flip-flop from time to time. I'm going to discuss a little more, 3 slides. If it fails and more tariffs come up, what is going to be the outcome? Okay, but before that, let's look at Brexit. As I said earlier on, for Brexit, what's likely to transpire, fudge and delay. We might want to look out for hard Brexit, but for now, in Phillip futures, our bet is on an extension deadline. This is likely going to keep markets on its toes till the end of maybe even the first half of 2019. So there's some, of course, is going to be supportive to gold, but largely I feel the market is not going to shift very strongly unless if it leans towards a hard Brexit. For Italy, of course, Italy and Brazil, not so much, but this is going to pose problems with its anti-established policy. So I guess viewers might want to take note and be slightly cautious with Italy and Brexit. But more importantly, the focus we have to go back on US and China. So actually, what will happen if the trade tariffs escalate? So first, we're going to see, okay, will US trade tariffs actually get the upper hand? So we've actually, if we look at this is the trade balance, right? Gold is 2016, light blue 2017, and of course dark blue is 2018, the trade balance. So we have seen that actually there was a widening. There's a widening in trade balance that actually took place after rising trade barriers were placed. Now this is likely due to the weakening of the RMB that has actually supported purchases, prevented a sharp descent in actually the trade balance. So China has sought to offweight this state weight loss, right, through looser economic policies and a weakening and a softening of its currency. We see that the escalation is not going to be good for the US, as actually fundamentals show that the trade balance did not tighten after the trade barriers have rise. So what we think that will actually transpire is weaker market confidence, global supply chain disruption that has lasting consequences, and you have seen that in the Chinese fixed asset investment levels. So all this is going to be very lasting, and is actually going to weaken. As we look at this up to November, right, as we compare year on year, there's a bigger deficit, and if we move to December, I think it's going to be very apparent that the trade balance is going to be wider from a year on year basis, despite a sharp pullback as we've seen in November. Okay, some of the key items I think we want to be a bit careful on, I think, just to let our viewers have a view, right? The reason, of course, US-China trade balance deficit, half of it, more than 65% actually stems from China. But the top 3 exports, all this have been taxed. So if our viewers have some of interest, in computers, cell phones, US companies that have this, or even in China, for US equities, those who are involved in aircraft, soybean, automobile, we want to be very careful, because these are the key areas that actually both countries are going to hit if the tariff come to pass. Although we do not hold a view that they are going to increase the tariffs, but this is just something that you want to be very careful about, as it will enact for much pain in the economy. So actually, what is going to happen if trade tariff escalated? I've condensed 4 key points. The first, global economic growth will weaken, supply chain disruptions, we might see rising inflationary pressures, and this increases actually total costs, which is actually not good for the economy. In terms of asset classes, right, that will be impacted. We see increased market volatility, and we have seen the loss of investor confidence have led to a massive sell-off. Now, the US, with widening trade and currency, a current account deficit is not going to be good for the balance sheet. And the key point I think you want to note is that should the dollar renminbi CNY CNH actually shoot past the 7, right? This is a difficult point where actually we might see the US dropping another shoe where they might label China as a currency manipulator. So lastly, of course, this is going to impact China's balance sheet. It's going to increase debt levels if Beijing chooses to use looser economic policies, right, to soften the blow from the US. Okay, so another key point, I think, why do I, as the third point that I've stressed earlier on, rising market risk. So what are we talking about? This is, I think I will spend some time to talk about the yield curve inversion. So we have seen the first yield curve inversion, although it's a 3-year, 5-year spread actually happening. So what we see is that we are seeing some negative point between this. So the last time it happened was about 2006 to 2007, where when this happened, right, it enacted for a recessionary effect, a sharp effect, where banks were forced to cut interest rate to 0% to boost the economy. Now, U.S. Treasury debt is a critical indicator. It compares credit quality, and the only thing that differs between the 3 and 5 year spread is their returns over time. Now, Treasury rates moves inversely to investor confidence. Now, when banks and investors feel good about the US economy in whole, the yields go up. Now, they feel confident in placing their money in sectors like mortgages, business loans. So now Treasuries have to pay high interest to compete. Now, when confidence declines, investors are likely to seek a safe place for their money. So Treasury bonds provide a unique form of safety. Now, of course, ordinarily, the yield curve follows a predictable course where long-term bonds outperform short-term bonds. But in this case, okay, we see an inversion where actually short-term bonds are actually more pricey than long-term bonds. Now, historically, this has happened in a few times, okay, and this is naturally during a recession. The key yield curve that is used as a bellwether is the 2-year and 10-year spread. So we have seen the last recession that happened 1999, 2000, the dot-com bubble, and also the GFC 07. It has happened before. The only exception that it didn't happen was in 1998, where it dipped very briefly, it wasn't placed here, during the summer, but it didn't lead to a recession. Now, economists and the general public has considered the yield curve as a reliable bellwether. So it don't mean to say that, because what we're saying is that the 2-year and 10-year curve has been very, very close to inversion. So if although the inversion actually, once it happens, it will precede a recession by 1 to 2 years. We don't mean that, of course, the market will collapse straight away. But if historical pattern holds true, we see that the yield curve might continue to weaken if the Fed attempts to raise interest rates, and maybe sometime in late 2019 or 2020. So I think I might say, I think 16 to 24 months between when the yield curve inverts, that is actually a very crucial moment. But overall, in view of all this and market risk, I think this adds weight to our analysis for slowing economic growth. So I think as investors, you want to look at the macro picture, you want to monitor economic fundamentals, look at the yield curve, especially the 2 and 10-year, this curve, to see whether, is this going to weaken, where's the market going to go in 2019. But of course, I think before I move into looking at the US dollar, I wish to say this. Are there any potential bright spots in the global economy? Is there going to be a turn for the better? Will there be a possibility of a 15-year, 5 more years of in a bull market? Okay, I would say 5 key points if it happens, if it's unexpected. So I think if I and the consensus, we might be surprised, we don't know. So what might transpire is that if there is a resilient US growth, a boost in maybe consumer spending, suddenly inflation rate goes up, this might actually start to push a pickup. We might see the Fed maybe cut interest rates this year. This might also boost US growth. Surprising ease off of US-China trade tensions where all barriers come apart. A recovery in Chinese business sentiments from all this that has taken place, and a sharp expansion in the emerging market. So overall, in our view, we feel the balance of risk is still tilted towards the downside. But these are 5 indicators that might show that the economy is much brighter and go against my view if it happens. So this is just a contrarian view for you guys to maybe have a look, have a feel for what's going to happen. So okay, a key variable. This I think I wish to spend a bit of time to talk about it. So the US dollar is really one of the prime movers, the core variable. So in our view, although we are bullish on gold, we continue to forecast for resilience for the US dollar in the longer term. Now, why is that so? The first I wish to discuss is the global interest rate differentials. So the dollar, the Fed is 2.5 short-term interest rate. The ECB, we're looking at negative. Bank of Japan, ECB is 0, Bank of Japan negative, the Bank of England 0.5%. So they're likely to tighten, I think, in the first half of 2019 in lieu of subdued global economic momentum. So this actually helped to actually keep the dollar firm. The dollar will likely benefit from wider differentials in comparison with other currencies. So this is likely to help to keep the dollar resilience. And if we look for it from a historical standpoint, the dollar has traditionally showed for resilience even in the past 2 previous recessions. It doesn't weaken that much. So in our view, I will just do a little technical analysis to give our viewers a bit more better understanding. I think it's likely going to be range bound between these levels, if I may. We still see the dollars trading sideways. More possibility. We're seeing some weakening actually for the last 3 to 4 days. So I think even if the case comes where it's maybe the dollar starts to move up, we think that it's likely to trade between this range. This is the dollar index, somewhere between 97.70, actually this area more, and also the key support will be about 94.02. So we do not see, I think, a very sharp. We believe that although this looks like a bullish channel, but we do not see that foresee this going much stronger. Yeah. So okay, before we go into product wrap, right, I will touch on maybe my market assessment for 2019, technical analysis a bit on spot gold. Okay. So for the first point, if you look at the trading outlook for 2019, overall, as I said earlier on, I still feel that there's a synchronized global economic slowdown across the developed economies, and this is likely to also impede sharp ascensions in the emerging markets. So this is likely to be positive to gold prices, as gold is a safe haven asset, a source of value maintenance, and also used by funds as a risk management asset. So this is important to note as well. So rising populism, the second point in global politics, we see geopolitical risks, Brexit, US-China trade tensions, we have the US-Iran as well, and even the upcoming 2020 US election. So all of this is likely going to disrupt financial markets, be a key stickler, and also raise geopolitical risks. And in lieu of all these rising markets, uncertainties, risk-off sentiments still will prevail in the market. So the third point, of course, late stages of the expansionary phase. We are in the later stages of the bull market. We have seen the yield curves starting to invert, or maybe flatter if I may. So all this likely to be positive, as the markets consider all the emergent risk market, both market and structural. But what is likely going to impede a very sharp climb for this year, I feel still that the US dollar is likely to remain vigorous. That's why although we think it's bullish, but it's not going to be extremely sharp. And from a pricing level point of view, technical, where does it go? Okay, so this is a flip chart that I pulled off over the months. Now, first I'd like to describe, if we look at it, right, in the past 6 years, gold prices have been relatively trapped. We've seen a sharp pullback actually as it reaches the 38.2 mark, somewhere between the 1,375 for spot gold. So this is a key level that actually impeded it. So we see that actually, although market has moved up on a Brexit, on the after the Fed decides to raise interest rates, but we do see that actually severe headwinds have been felt around this level. So a key point is for now we feel that it looks likely to go up higher, test 1365, 1375 in the coming term. But a key issue is on the central bank's policies and what is and the economic indicators that transpire. For me, although some people in the market has been calling up for the break in the 1,400 mark, I feel that there must be more. There must be more um, solid indicators like as we're close to a recession. Most probably then you will test the 1,400 mark. So for me now, I'm still bullish. I believe that it will trade 1,375, maybe range after which if it doesn't break, it might retrace range between that level. Now, but if I'm wrong and it breaks the 1,375 mark, we might see a very strong push towards the 1,400 mark. So when this happens, right, because we're going to see it might test maybe the previous highs in 2012. But for now, what's likely to happen, I think, strong support, 1,300 key psychological level. And of course, as we move further up, more towards 1,375. Maybe in the first quarter, it looks like it's going to test. Then we have to see actually what happens. Okay, so another way, I think before I go into product, I'd just like to share our house view on asset classes based on everything I said. I think this gives you a snapshot. From a macroeconomic perspective, we do see a synchronized economic slowdown. Global central banks to keep rates neutral. First half 2019, lagged effect of financial deleveraging policy to slow global economy. Global equities, I think higher borrowing costs is likely to constrict market liquidity, weaker corporate earnings, softer asset prices. And of course, we want to pay attention to this as these are interest-bearing assets, give dividends. So gold is a non-interest-bearing asset. So a very good performance, strong, robust performance is likely going to give some headwinds to gold. So for Brexit extension, looming possibilities of hard Brexit, that is very dangerous. It's going to pressure market confidence. Emerging markets is going to slow, we feel, with all this, and also the escalation, if it happens, is going to impact growth potential. But for now, I think emerging markets are still teetering between still nuanced, quite positive. But gold, our favorite, bullish, very bullish in lieu of the softer global growth prospects, heightened geopolitical risks, and rising safe haven appeal. Balance of risk is still tilted towards the downside. Okay, give you a market wrap snapshot, things that you want to look at as well. Monetary policy guidance, US Federal Reserve minutes is out tonight. Might want to take note. What's likely transpire is patience. US-China trade war, if it escalates, it's going to aggravate weakness in the global economy. Rising populism in global politics, you want to see, this is going to cause geopolitical risks, volatility. And lastly, emerging markets, debt and currency crisis if the dollar remains strong. Okay, so come to a key point. Okay, so how can actually investors trade gold? So what's there in the markets for gold? So just an example, as Phillip Futures, we are brokerage. We offer gold futures from CME Group. So we can see each unit is 100 troy ounce, mini is 50, both denominated in USD. Tick value 10 cents, profit and loss is $10 per tick. So you will need, for example, for a standard contract, you need $3,740 to initiate a position, a margin, a safety buffer. And then for mini, half the size, 1,870. So both contracts are offered by CME Group on the exchange. So actually, okay, maybe just give me some time to share with those maybe how can you trade gold contracts if you are not familiar. So I'm going to just pose a view. If you want to profit from an upswing in gold, you assess that some upside potential, you decided not to go into stocks or ETFs, you want to go into gold futures. Why? Because it's the first responder to play moves in the gold market. So for example, in the first February, if the trader buys five gold contracts in April 19, the price is 1,300, the contract size 100 ounce. The initial margin you must pay to front up the position is $18,700. Now the next day, assuming that everything goes to your favor, it appreciates by $10. So 1,310. Your total P&L at this point of time is $10 per ounce times 100 ounce per contract, $1,000 per contract, and of course times 5,000 in total profit. But of course, please note that risk and reward is in tandem. If the market moves against you, $5,000 in loss. So of course, okay, I think allow me, if I may, as a brokerage standpoint, why should you trade gold contracts? So of course, first, pricing action. Futures are the first responders. It always responds first when ETFs and stocks. Direct play, it has market-based consideration. Market sentiment moves the markets. Execution costs with leverage is affordability in brokerage charges. Capital efficiencies are also welcome. Market liquidity, there's a diverse base of clients, so you're trading against as hedgers, funds, and everyone else. Counterparty risk, of course, there's clearinghouse safeguards to ensure that the obligations are met, and also it's close to 24 hours of trading, just 1 hour wait. So of course, I think, but do note, of course, futures trading, leverage trading is not meant for everyone. You should speak to our brokers or even our business development executive for more information on how to trade gold, or actually, before you actually invest in gold. So without further ado, I think I'll hand it back to Sri. I will take some questions. I'll be here, to address some of your concerns. Sri?
All right, thank you so much, Ben, for that enlightening presentation on what the prospects are for gold in 2019. All right, so if you have any questions pertaining to the lovely yellow metal, please send them our way. Just type them in the question box, and I'll narrate them for Ben. Thank you also for being such a wonderful audience today. Let's have some questions, and we'll get Ben started with the response. All right, we have our first few questions on the line. First one is from Xiao Fang Ng. Can you please comment on micro gold contracts? Do we have them, Ben?
Hi, sorry. So for micro gold contracts, we do have them on CME, but because we understand that you can trade that on CME as well. There's a 10 troy ounce actually, or is it 1 troy ounce actually? So we do have that. So because I know that some of you might come from, some of our listeners and viewers are from different countries, and there are different jurisdiction and legal restrictions. So I think we do have them. Of course, from CME Group, we also have, for Phillip Futures as a whole, we do offer spot gold on FX, but it really depends on your jurisdiction. So for this, I would encourage our listener to speak to our business development executive. I think after the end of the presentation, you'll see some links. Then your BD and your broker will better advise you. But it is micro. We do offer micro futures contracts.
All right, the next question that we have is, what's the house investment strategy for first half and second half 2019?
Yep. So for us, right, I think it's important that I clarify this point. For Phillip Futures, we are an agency business. So we are brokerage, and we do not take positions in the market. We do not take positions towards the client. But from us, from a research standpoint, we are still fundamentally, as I stressed, bullish towards gold, at least for this quarter, in lieu of the market fundamentals. So if I may just reinforce my viewpoint, we are currently seeing from all across the board, economic indicators have shown much weakening in PMI, retail sales. All these are leading indicators. So we have seen, for example, the effects of monetary policy tightening is going to kick in, and all this has already actually, to be honest, has already kicked in. You can see much softening. But of course, as we look at the right hand side of the chart, we're thinking, where are prices going? So for now, as I see, there's a very sharp and solid break. We can see gold prices actually within February. Actually, it has been for first quarter, it has actually broke through key levels at 1316. It broke through 1325, and actually this week, after being range bound for 2 weeks on competing influences on the dollar and also US equity markets, we have seen sharp growth. So in view, even if as what we see, although we see robust showings in the global equities market and also the US dollar, we have seen that actually there has been little to deny a bullish ascension in gold prices. So in the shorter term, definitely, if in my view, if I may say, I'm looking at 1365 minimally for this quarter. But of course, the market is dynamic. Things might move against, might change. My view might not be right. But for now, to say, I think I would suffice to say the downside risk is, I feel the balance of risk is still tilted towards the downside rather than the upside.
All right. Thank you so much, Ben. All right. We have a question from. We have a question from Chok Richie. Before we go there, we have Kasidet from Thailand saying hi. Hi, Kasidet. Good to have you in the webinar today. All right, Mr. Chok Richie has a question. Is there any firm relationship between gold and other metals like silver or platinum?
So I think traditionally, I think the markets has always compared the gold and silver ratio, and also they've tried to, I think they've put precious metals together. I think there's definitely a form of relationship, but to be honest, my personal preference is to look at the asset class on its own. The reason is because silver, although it's also classified as a precious metal, has a lot of industrial usage. So with this, right, and the weakening of PMIs across the board, right, there might be a breakdown, you see. So when I look at gold as an analyst, I tend to actually appreciate, my preference is still towards the dollar, competing influences from global equities. Because if you look at current term market conditions as a whole, you are seeing that you are in the last phase or the later stages of the economic expansionary phase. Now, this is very important because gold is also has this, as I said, is a safe haven asset. So traditionally, markets, funds, prop traders and whatnot, they have been using this as a hedge for the currency risk and also as a store for value maintenance. So if we look at gold, if I may, I would suggest that actually, besides looking at these correlations, I would think maybe focus a bit more on the dollar and also maybe on what's happening in the equities market. Sure, there might be some competing influences from the yen, the Swiss franc, but overall, it's in our view that these safe haven assets and currencies, right, is going to do well for 2019 in lieu of current term market fundamentals.
All right. Thank you so much, Ben. All right. We have one more question from William Cole. Just to recap, why is US dollar inverse to gold prices? The classic question about the comparison between the dollar and US gold. Ben, are you able to be more detailed with this comparison?
Okay, so the first I think we have to look at is that gold and the dollar, as I said, right? The gold and dollar, for the first thing is that gold as a commodity is denominated in a dollar, in US dollar, sorry. So the first thing is that if you look at gold, right, as an investment vehicle, right, it's a non-interest bearing asset. Now this is very important. So if you choose to invest your money in gold, at times where, for example, in this case, where monetary policy and US monetary policy was pretty hawkish in the last 2 years, you will lose out on interest. So that is why when we look at the equities and everything, the equities it bears dividends, it yields dividends, sorry. And for dollar itself, it yields interest for holding the dollar because of the global interest rate differentials. Now, in a situation where the market is positive, holding gold as compared to holding a dollar, where you are in a leverage trading, right, where you will incur things like swap costs, interest costs for holding gold if you're doing leverage trading. So when we look at these two asset classes as a whole, you must consider, the first point is the interest rate differentials, and also what is the opportunity cost of holding a dollar against gold. So that is the first point. But in our view, the reason why we feel positive about gold is that there is macro factors in play now, which is the slowing global growth, weakness, possibility. So when we compare this, if you look at it from a gold US dollar perspective, we do see positive aspects for gold. But if we look at, so it depends on how you look at it. If you look at gold as just a sole investment vehicle, gold futures, right? You want to look at the dollar to make sure that, if you invest, what's happening to a dollar, because the key issue is opportunity cost. So interest is the key reason why, as you look at this relationship, right, it's important So as once again, to sum it up, right, gold is a non-interest bearing asset and the dollar is an interest bearing asset. So opportunity cost is the key here.
All right, we have one more question from Xiao Santan. That is pertaining to currencies. Is the ringgit undervalued by 10% against the US dollar? We'll get our currency analyst to perhaps address this offline. All right, thank you so much for being a wonderful audience. Do we have time for one more question, Ben? All right, the question is from Alan Sin. Will USA's emergency declaration potentially boost gold prices? Wow. It's a very big question, Ben. What do you think?
Okay, I think for this aspect, right, it depends on the subject matter. Now, gold is, of course, is a safe haven appeal. So it really depends if what does the market views on this. For us, for now, we see the Trump administration moving towards certain directions. I think market has been relatively really priced in on this geopolitical risk and economic risk. That's why we are seeing that actually it's slowly starting to move upwards. Central banks have been starting to purchase more. If you notice, for 2 successive months, China actually purchased more gold. So I think it's likely going to drive prices up. But the key level you're seeing now, right, is I think if I may go futures is trading somewhere in about 1341, 1342 currently. The upside, I think we are seeing towards 1365, 1375. Now, so it really depends on how the market reacts on this too. In my point of view, the declaration is I don't think it might cause positive, definitely, you know, I mean, it's going to raise safe haven appeal in the longer term geopolitical risk, but it really depends if the core effects we need to see, you see, how what is the underlying statements, what are the things that they affect. So for now, I think although the states are going against him, you know, some states have actually lodged an appeal. I think this process is going to be a bit draggy. It's going to, of course, underpin safe haven appeal. But for now, I think suffice to say, we've seen the market moving up, right? But I think it's more due to dollar weaknesses before the Fed minutes actually transpiring, because the markets are starting to expect for dovish signals. But overall, as I said, definitely if you look at the larger picture, macro economics, dollar, geopolitical risk, definitely is still going to be beneficial for gold in the current term.
All right, thank you so much for being a wonderful audience. This has been our webinar on World Gold Shine in 2019. Do look out for our webinar coming up next month. We have yet to firm the details, but do look out for our marketing email. All right, thank you for being a wonderful audience with great questions as well. Have a good night and a great trading week ahead. Bye bye.